So let's get to Steve Leisman, who is with one of the potential Fed picks, who seem to have gotten more popular as time has been going by. And even before he was mentioned, we had talked about him and talking about cuts way before that. Chris Waller. Hi, Steve.
Yes, we had Joe, and I am joined by Fed Governor Chris Waller, who, because he's right here, he's my pick right now. Which, thanks for joining us, Governor Waller. I want to start off with what is among the most interesting things in the market right now, which is what's happening with the bond market. And you have these the 30-year yield inching up towards 5%. The 10-year seems to be stuck around 4.27. The 2-year seems to be anticipating, I don't know what, but a lot of rate cuts from the Federal Reserve. Give me your view of what's happening, particularly on the long end, and how you think about that.
Yeah, I think on the long end, which of course we really have very little influence over 30-year yields, they've been ticking up. We've also seen some of that globally yesterday. But the 10-year's kind of been anchored right where it is. So if there's anything that was worrisome that was driving the 30, you'd think it would also start affecting the 10. But it's not. It's kind of anchored there. And as you said, on the short end, the markets are certainly pricing in cuts from the Fed in the next few months, which is probably a reasonable estimate. So it kind of makes sense in the short end. The long end, I'm not exactly sure, and the 10-year is kind of staying there. The 10-year came down a little bit from about 430 down to around 440 down in that area. So it really hasn't moved much, and it's got a little bit of the Fed cut built into it.
The 10-year does.
Yeah, but it's 10 years out. So, thinking of a couple of cuts in the next few months is unlikely move rates 10 years out. So
give me your view of why the 2-year looks like it's potentially got a couple cuts in it. Is that your view? Is it one cut and then many more? How do you game things out over the next several months?
Well, I've been clear that I think we should be cutting at the next meeting. The labor market has come in much softer. When I first said this with you, I think a while back,
June. Yeah.
People thought I was crazy. But once the labor market data came in on August 1st, it became pretty clear that the labor market was not performing up to what everybody thought from the original estimates. But we were getting all this anecdotal evidence at the time saying no hiring, no firing, firms are laying off, rates were going up for new entrants, AI was potentially causing problems. So all that software, ADP had big negative numbers, so all that data didn't seem to match up with what the BLS was putting out. And that's kind of where I felt like the BLS numbers have got to be off in some way. And then we found out in August that they really were. So I think because of that, and you want to get ahead of having the labor market go down, because usually when the labor market turns bad, it turns bad fast in a non-linear fashion. It doesn't just kind of creep up. So for me, I think we need to start cutting rates at the next meeting, and then we don't have to go in a locked sequence of steps. We can kind of see where things are going because people are still worried about tariff inflation. I'm not, but everybody else is. So I would say over the next 3 to 6 months, we could see multiple cuts coming in. Whether it's like every meeting, we'll have to wait and see what the data says.
And where are we headed, in your opinion? Do you have a view of neutral, of where you'd like to get to, or do you need to even be below neutral?
Well, like I said, I usually use the SEP benchmark.
That's the Summary of Economic Projections. That's the average of all the Fed officials and their long-run rate.
Right. So that gives me kind of a benchmark where the middle of the committee seems to be, and I use that to think about where neutral is. Could be higher, could be lower. You have people all over the map on this. So, but if you take 3%, you're about 125, 150 basis points above that. And if tariff inflation looks like it's going to be temporary and it's a one-time level effect, which I think, inflation expectations are anchored, and the labor market's really weakening. So our dual mandate says worry about employment and inflation, look through the inflation, worry about the employment, start cutting.
Let me give you what I think is a textbook argument against what you're saying, and you tell me where I'm wrong with the textbook. You have a target at 2%, your inflation number is at 3%, and some people argue going higher. If you cut now, are you saying we are not really going for that target of 2% anymore? Are you undermining your target and your anchoring of inflation expectations?
No, and I think that's where people mistake what do you mean by looking through. You know that you're going to have this surge of inflation from the tariffs in the short run, but it's not going to cause long-run inflation. So the whole idea of looking through it is to say, yeah, we know we're going to have this blip of inflation, but it's not permanent. And so why, for a one-time level effect, you want to start, say, raising rates and damaging the labor market, the housing market, and everything else when you know in, say, 6 months it'll stop? So that's the classic view of what it means to look through is, yes, it is going up, but that's what looking through means. You're looking through saying 6 months, 7 months out, it's not going to be going up. It'll be starting to move much closer to our target of 2%. So it's not about letting inflation go. You're just looking through, and that's the critical part. It's very hard for people to think about what that means. But I'm looking through saying inflation 6, 7 months from now is going to start moving back closer to our 2% target.
Do you think that over time that the inflation numbers will be clear as to what the direction ought to be in terms of how much you should be cutting, and that whether or not you start to get that help from the service side and the housing inflation starts coming down, and it'll be clear to everybody out there?
Yeah, that's why I said what we want to do is start cutting because of the labor market, but we can always adjust the pace depending on how the data comes in. So I kind of use this analogy that, you know, when I was in college in northern Minnesota, I'd drive home for Christmas. I knew what the ultimate destination was, but how fast I got home depended on the weather, which is the incoming data. And that's kind of where we're at now. We kind of know we want to get towards neutral. We know roughly how much you might want to cut, say 100, 150 basis points. But how fast we get there is going to depend on the data that comes in.
Is the speed something where you feel like if you remain at a certain place, you're still putting downward pressure on inflation because you would remain above neutral?
Yeah, if your rates are above what you think is neutral, which for at least half of the committee is 3%, then policy is still moderately restrictive. Some of my other colleagues have a much higher neutral rate, so they think we're barely restrictive. So that's really kind of the thing, is where you think neutral is depends on how much you think there's restrictive policy. And I think we see it in a lot of sectors. You're not seeing housing taking off. You're not seeing auto sales booming. These are things that are typically interest sensitive on the household side that we're putting downward pressure on.